Hello, I'm Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We've got a great show for you this Sunday morning. Of course, if you have questions about your portfolio, whether it's about an investment, maybe somebody's trying to sell you one of those crummy annuities, maybe you own some mutual funds that are not doing well, maybe you own some stocks or bonds, or maybe you're just concerned about your retirement cash flow. Send those questions to Brian Rezny at ReznyWealth.com. And make sure you do visit our website, ReznyWealth.com. We've got all kinds of great free reports for you. Why annuities are dangerous to your wealth and retirement. The 3 biggest risks to your overall wealth. All those are free and they're available on our website at ReznyWealth.com. The worst enemy when it comes to building wealth. We're going to talk about that today. We're going to cover some of the things that I often, that really plague you, the investor. Whether you're a pre-retiree or retiree, you know, I've been managing money for over 30 years. I see, unfortunately, a lot of mistakes being made, mistakes that could easily be corrected. We're going to talk about some of those, and we're going to talk about ultimately what real advice means to your wealth and your financial security. Emotions and greed. People tend to be emotional and they're greedy. Let's face it. Why do you think equity index annuities are sold so much? People are sold on emotions, losing money, and then they're sold on greed on free money bonuses. There are no free money bonuses and there are no 8% returns on annuities. These things are garbage, but they're sold on emotion and people are greedy. All investments have emotion and greed. The key for you, the investor, is this. Realize you need to take some degree of risk in your portfolio in order to make a decent return. If you will not accept volatility, meaning you have $1 million. If your $1 million dropped $1,000 and you're highly emotional, you're probably not an investor. You should go to the bank, park your money in maybe a laddered CD approach and call it a day. There's nothing the matter with that. There's a lot of investors like that. Then they go seek out these annuity charlatan people and they get ripped off. Don't do it. If you're emotional, you're not a risk taker, there's nothing the matter with a CD approach, call it a day. If you're an investor, though, that can handle a little bit of volatility because you realize this is your friend and you're looking for a better return opportunity, then be a real investor. Lack of investment strategy is a big one. I often have individual investors that are self-managing their money that'll come into our office. They have pretty poor returns. I will always ask them, do you have a copy of your investment strategy? Very few do. Managing money over 30 years, talking to thousands and thousands of do-it-yourself investors, I've had 5 in that time frame that actually did a good job on their own. But they had a real strategy in writing. They spent real money on research. They spent 20, 30 plus hours a week managing their own money. I asked them, why'd you come into our office then? You're doing a good job yourself. Because if I pass away, I don't want my wife to fall prey to one of these Wall Street brokers, bank people, or the annuity charlatan people you often talk about. But a lot of individual investors that self-manage, they have no strategy. Your returns often are lackluster or downright lousy, and you have more risk and volatility. It is time that you develop a strategy if you don't have one, or get real professional help. Don't chase what's hot after a big run-up. Often what I have is at the end of every calendar year, there's always a list published. The top performing ETF, the top performing mutual fund, the best performing stock. What happens on my live shows then? A lot of the calls come on those stocks. Oh, that was the best performing stock last year, Brian. What do you think about me buying that for my portfolio? That's not research, folks, and that will get you into trouble. It's been proving. Buying last year's big winners are often very detrimental on your portfolio, not only for bigger losses, but mediocre or downright lousy returns. Don't do it. But that's how a lot of investors manage their own money. They chase what's hot. There is no free lunch when it comes to risk. So I'm going to tell you this again. If you are a non-risk person, meaning you cannot handle a little volatility, and a little volatility is 5 to 10% swings in the value of your portfolio in any calendar year, you will have no ability to make a decent return on your money. That means you tend to be more emotional. Again, everybody's geared a little different. If you're an emotional investor, go to the bank, buy a laddered CD approach of 1 to 2 years, and call it a day. But if you realize you're 65, you're 70 years old, you're 75, one of you is going to be around 20, 25, 30 years. You're a long-term investor who's looking for income and growth. and you can accept some of this into your volatility, you'll have a great opportunity to build wealth, build your retirement even more secure, because you realize a little volatility is your friend. Most investors invest too conservatively, but then they get risky after the big run-up. I see this all the time. Investors are real conservative. Holy cow, Brian, the market did this last year. Do you think we should be more aggressive? No. Pick your spot. Pick your risk profile. If you're more moderate, stay moderate. If you're more growth or aggressive growth, stay in that spot. Don't ramp it up after things are rosy, because ultimately you could have a pullback after that run up, and then you're going to be, oh, I made a mistake, and then you get more conservative, meaning you basically bought high, you sold low. Have a consistency with your strategy and risk profile and stay with it. Reversion to the mean. Anytime an investment really outperforms another, I'll give you a great example. Let's suppose you have a portfolio that's half your money's in the S&P 600 small cap stocks in the US, and the other half is in S&P 500 large cap. And let's just assume large cap goes up 20% this year, and small cap only goes up 10. Often what happens is called reversion to the mean. Large cap really outperformed too much. It'll often kind of have lackluster returns the next year, and maybe then small caps kind of catch back up. So anytime you get these big disparities in returns of a portfolio of an asset class that is somewhat similar, reversion to the mean always kind of kicks in. But what do investors always do? They'll want to sell the one that didn't perform as well temporarily and load the boat in something that outperformed, only to see the reverse happen potentially the next year. Big mistake. Reduce bond investments. I can tell you, again, managing money for over 30 years, I see a lot of retirees and pre-retirees own way too much bonds. Too long a duration maturity in the bond or bond investments, and too big of a percentage in that bond portfolio. Ultimately, bonds are not safe investments. They can have volatility just like any other investment, and there's times they can have as much volatility as the equity market. But investors think magically they're going to get rid of volatility completely. You're not going to, and you're not going to do that with an oversaturation of bonds. You're going to reduce your return a lot, especially given rates are as cheap as they are today. Hire a real advisory firm to manage your wealth, a fee-only fiduciary. The vast majority of investors, we estimate 90+% of you are currently working with a sales organization with a fancy title. Banks, Wall Street type firms, brokerage firms, and insurance companies, none of these are fee-only fiduciaries. None of them. So that means they legally do not work for you 100% of the time. Some might do fee-based business, which I consider quasi-fiduciary, but you might have another account that's under suitability where they can ultimately take you to the woodshed, and they don't have to sell you things that you're suitable to buy. If these are new terms for you, you need to attend one of my upcoming workshops eventually and really learn more about this. But again, hire a real firm. You go to some of these firms, they call their people wealth managers. They're not managing any wealth at all, or vice president of investing. If they're not a fee-only fiduciary, they're not a real advisor at all. I've got 2 upcoming workshops, one in Naples, one in Fort Myers. If you want to learn more, if you want to protect your wealth, the disturbing facts most investors are shocked to learn: how investors get ripped off by Wall Street, banks, and annuity charlatans. Learn how to protect your wealth from bad advice, and a whole lot more in my upcoming workshops. Again, Naples, Fort Myers. Go to ReznyWealth.com. That's ReznyWealth.com. Click on the workshop tab to sign up and for times and availability. If you want to learn more, if you've got a $500,000 portfolio, if you're a retiree, you're realizing a lot of things that I talk about on my TV or on my radio show are starting to resonate, and you're realizing, hey, we've got some of this garbage in our portfolio. Attend one of our workshops, or better yet, call our firm for a consultation. We do manage larger portfolios. I'm going to go to a quick commercial break. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. I've managed money professionally for over 30 years. The biggest mistake I see investors make: being sold an annuity. Annuities are sold on blatant lies, fake free money bonuses that never materialize for you, the consumer. Before your retirement gets ripped off by an annuity salesman, get my free report, Why Annuities Are Dangerous to Your Wealth and Retirement. And we're back. Of course, we're taking your questions. Send them to Brian Rezny at ReznyWealth.com and visit our website, ReznyWealth.com, to sign up for a consultation with my firm. If you're looking for money management services and your portfolio is $500,000 and larger, call our firm, schedule a consultation. Let's get you back on track. Marissa from Madison, Wisconsin, financial and bank stocks as an investment, your thoughts. I actually like them. The big thing is this, don't overload the boat. So if you're going to buy banks or financial type stocks, the XLF might be an opportunity. That is an ETF, the XLF. It buys a broad basket of financial stocks. I would rather see you invest that way than trying to buy one or two bank stocks on your own. You'll still have an opportunity for dividend, growth of portfolio, of course, so there's a total return objective of that ETF. That would be a way you could take a look at the financials and actually have a diverse portfolio without going it alone. Terry from Fort Myers, Florida. My advisor wants me to switch my variable annuity for an equity index annuity. He says it's better. Your thoughts? Terry, your advisor's not an advisor, first off. Your advisor's a salesman because he sold you a variable annuity. Variable annuities are complete garbage and have crazy high expenses and rob your return and give you more risk. They're garbage. They're usually sold through brokerage firms and banks. They're garbage. Yours is obviously no different. Now what your advisor, really a salesperson, wants to do is you're probably past surrender. He wants to reload his commission in his pocket and put you into a crummier equity index annuity. Variable annuities are crummy. Equity index annuities are even more crummy. Do not do it. Find yourself a real firm, not a sales organization. Anybody who sells annuities for commission is a sales organization. They're working under suitability, and they don't legally work for you. Don't reload another surrender penalty. If your portfolio is $500,000 and larger, Marissa, call my firm, schedule a consultation. Let us look what's going on, and let us get you back on track with real advice and real money management. Joe from Naples, Florida. What do you think about DAX as a way to invest in Germany? DAX is an ETF, folks. That's a symbol for it, an exchange-traded fund. It buys a broad basket of German stocks. Do not do it. I don't like Europe at all. Europe is a cesspool of socialism, and it's been like that for decades. So think about this. When you invest in Europe, and Germany is a part of the EU, of course, you're basically invested in low-growth economies. There's no reason to do that. Now, I will tell you this. A lot of the new accounts that come to my firm every week come from the big brokerage houses or banks. They always have a helping of Europe in their portfolio. And I asked the client that's hiring us, have you been happy with that portfolio? And they're like, no, not really. And I said, what is it that disturbs you the most? They often will tell me, Brian, I know you talk a lot about Europe and to avoid it. I'll bring that up to our advisor or so-called advisor. And he'll say, oh, we have to be diversified. Investing in Europe isn't really giving you any more diversification, folks. But if you take a look at Europe as a whole, the returns have been lousy for decades, and the volatility is still there, or maybe greater. So why invest in something with the same risk or more risk than the U.S., but with lousy returns for decades? It's not going to change because their policies are not going to change. We've got 2 upcoming workshops. The disturbing facts most investors are shocked to learn. How investors get ripped off by Wall Street, banks, and annuity charlatans. Learn how to protect your wealth from bad advice. I've got 2 workshops, Fort Myers, Naples. Go to ReznyWealth.com. That's ReznyWealth.com. Click on the workshop tab. I'm going to talk not only about how not to be taken advantage of with your portfolio, but I want to talk about the economy and the year ahead, what you should and should not be doing with your wealth. We want to help you protect your wealth. We want to show you how to properly grow your wealth so the retirement you want is the retirement you're going to receive. I'm going to take a quick break. I'll be right back with more questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Investors are getting smart. They are moving away from conflicts, bad advice, and being sold junk investments from firms that are not feeling fiduciaries. Smart investors demand real advice and real money management 100% of the time. If you're tired of the financial runaround, download my groundbreaking report, 3 investment risks you must avoid now. And we're back. Of course, we're taking your questions. Send them to Brian Rezny at ReznyWealth.com. Make sure you do visit our website, ReznyWealth.com. We do manage larger portfolios of $500,000 and greater. So if you're concerned about the way your wealth is managed, if we're bringing up a lot of points in this show and past shows that you're starting to realize the alarm bell's going off, I always try to tell investors, it doesn't hurt to talk. If you're looking for advisory services, if your portfolio is $500,000 and greater, and you're realizing the advice you're getting isn't really the advice that's good for you, call my firm. Schedule a consultation. Don't be taken advantage of any longer. Stop the bad advice and the conflicts. We want to help you, but you've got to help yourself. Give us a call. Schedule a consultation. We'd love to talk to you and get you back on track. Terry from New Orleans, last year was a really good year for the stock market, but my 401k plan didn't perform as well. My portfolio, 20% mix of growth and value mutual funds and about 40% bonds, with the rest in international mutual funds. The S&P was up almost 30, but I was up only 4.6. What should I do? It sounds to me like a couple things, Terry. First off, what is your risk profile? And if your risk profile is not ultra conservative, you might want to change your mix. What I will tell you from what you're telling me that you're invested in, you're not in the right areas at all. Ultimately, I would say if you're trying to be more of a balanced investor, let's say that's a level 7 out of 10, maybe have 10 to 20% in short-term bond-type investments. The rest of it should be invested primarily in the U.S. marketplace. Dump Europe like a hot rock. It's no good. It hasn't been good for decades, and it's not going to be good, in our opinion, the next decade or two either. It's no good. Invest in more on the growth side of the mutual funds. I really don't like mutual funds a lot anyway, but you're kind of stuck because it's in the plan. What I would say is, if you're retired or you can do an in-service transfer, you might want to consider that as an option to have the money professionally managed with more options and potentially better options and a strategy. But you need to change the mix. You need to dump what you've got in there, especially those international type funds. It's a cesspool of socialism. They're not going to help your portfolio. But I can tell you this, 9 out of 10 investors listen to my show that are working with banks and brokerage firms. They've got a bunch of Europe, a bunch of international in their portfolio. If you look at the returns of these things, they've been lousy. The volatility's been up. You're not getting paid for the risk. Get rid of them. Move into greener pastures. John from Fort Myers, Florida. Is it time to add risk to my portfolio? Will we continue to grow? Should I invest in the stock market? John, it really depends on your risk profile. If you're more of a growth investor, you should have already been invested. Now, while the markets are good, you always want to be looking for the next big bad recession. We're going to talk about that and a lot more at my upcoming workshops in Fort Myers and Naples. Go to ReznyWealth.com for times and availability. But ultimately, it sounds to me like you need real management. If you're already not invested properly and you're asking that question, should you put risk on now, meaning put money in equities, why weren't you doing that 3 or 4 years ago? Who's managing your money? Are you doing it yourself? Maybe you're doing a poor job. Maybe it's time for a real money management firm like Rezny Wealth Management to take over the hard work. That will ultimately help you alleviate the tension, the problems, and the stress that you're probably currently experiencing. Jen from Cape Coral, Florida. Is Europe a good investment for investors? And what would you buy? Jen, Europe is garbage. I've had a couple questions on this, by the way. And I'm going to go back to the same answer. If you own Europe, you shouldn't own Europe. If you own a lot of other international investments, you probably should not own those either. We often will see portfolios that come into our office. They're ladled with different investments, international, maybe some of the emerging market economies. Some of these areas on the emerging market economies are potential. There's a lot that are garbage. But I tell you what, as a broad-based comment, Europe is garbage. Dump it. Move more to the U.S. Stay on the growth side and take a look at small cap in the U.S. I think that's an area for a piece of the pie that needs to be in portfolios, especially if you're trying to grow some of your assets for the future. We've got 2 upcoming workshops. The disturbing facts most investors are shocked to learn. How investors get ripped off by Wall Street firms, banks, and annuity charlatans. Don't let that be you. Learn how to protect your wealth from bad advice. I've got 2 workshops, Naples, Fort Myers coming up. Go to ReznyWealth.com. That's ReznyWealth.com for times, availability, and to sign up. Our workshops are specifically designed for pre-retirees and retirees who have a $500,000 portfolio and greater. If that's you, if anything that I'm discussing on my show is starting to resonate and red flags are going up with your current relationship, attend a workshop. Or better yet, call our firm for real investment management. You'll be glad you did. Rob from Miami, Florida. Which investment sectors are moving up and which are down? You mentioned healthcare earlier this year. Rob, I actually like healthcare, and we do own a position of that in our portfolios at Rezny Wealth Management. I think healthcare is undervalued, and it's a great opportunity going forward. We've owned this, by the way, for a number of years, and it has done quite well. Past performance, though, is no guarantee to the future. But I think it's a great opportunity. Healthcare, everybody needs it. Ultimately, we've got a population that is going longer and longer and longer, obviously, on age. Healthcare is going to be needed by everybody. It is a cheap sector, and I would say as a part of a portfolio, if you're more of a growth investor, you could go as high as a 10% allocation to healthcare, and I would not have an issue with that. I think there's great opportunity in healthcare, and I don't think enough of you investors have that as a sector bet in your portfolio. Tom from Miami, Florida. What is your top sector pick right now? What signals do you look for to decide if it's time to jump in and out of a sector? Tom, that's another great question. Really, our top sector right now, in our opinion, is really healthcare, followed by technology. But I will tell you this, technology, while the growth potential in technology is a little bit higher than the healthcare side, technology in general is getting pretty fairly valued, and some of it is downright overvalued. So tread lightly on the technology side. Healthcare, in my opinion, is a better opportunity. I think it has less risk than technology. It's much cheaper priced. The growth potential is there. And again, we've got a population that is living longer and longer and will require more and more medical assistance, which is a great opportunity for your portfolio. Tim from Fort Myers, Florida. Are investors facing a decade of flat to negative bond market returns? Tim, I love that question, and let me tell you why. I firmly believe they are. Interest rates, remember, folks, when interest rates go down, bond values go up. Well, interest rates, if you look at the 10-year Treasury, we're looking at rates that are about 1.6, let's say 1.7 on the 10-year Treasury. That is some cheap money. Could it go to zero? Potentially, I don't see that happening. So if interest rates don't even change up or down, the return on bond investments that people saw 10 years ago are not going to be the same return they're going to see in the next 10 years because interest rates can't go down as much as they did over the last decade. So you're not going to get capital appreciation. So one of the comments I made earlier is about reducing bond investments. Too many of you retirees have too much money in bonds. Bonds are not necessarily safe. They can be at times as volatile as the equity market, sometimes more, sometimes less. I ultimately think you, the investor, need to look at what's called total return. Growth of principal and dividend stream, add those together, give you total return. I'd rather get a dividend stream with some growth potential versus buying a portfolio that is saturated, over allocated to just bonds or a lot of bonds. You, the investor, is making a big mistake by doing that. But I will tell you, doing this for over 30 years, Wall Street firms and banks always push that. You should own your allocation to bonds based upon your age. That is hogwash. Don't do it. If you're a conservative investor, maybe have a little bit larger allocation, but to shorter term bonds. Maybe if you're more moderate to growth, definitely have less bonds or maybe no bonds. There's times that bonds do not make sense in a portfolio. And right now, in my opinion, I think a lot of investors, again, are over allocated. We've got 2 upcoming workshops. This is your chance, folks. Fort Myers, Naples, go to ReznyWealth.com. The disturbing facts most investors are shocked to learn. How investors get ripped off by Wall Street, banks, and annuity charlatans. I'm going to talk about that and a lot more. I'm going to talk about the next recession, the economy going forward, where you should be invested, where you should not be invested. This workshop is specifically designed for investors who have $500,000 and greater. If your portfolio is that size or larger, you should attend. You should learn maybe what you should have learned 20 years ago, but it's not too late. Go to reznywealth.com, click on that workshop tab, sign up for the workshop, pick one of the 2 dates. If you don't want to come to workshop, a great way to talk to our firm if you're looking for advisory services and you have a larger portfolio, call us for a consultation. You know, I've done a lot of radio and TV shows over the years. I've educated you, the investor, a lot. One of the biggest things that I always encourage is do not procrastinate. If you sense there's problems in your portfolio, you're realizing a lot of the things that I've talked about on my TV or radio shows, it's resonating with you. You're realizing a lot of the things I talk about that are bad aren't prevalent in your portfolio. Things you should be doing, you're not doing. It's time. Get off the couch, pick up the phone, schedule a consultation. Get that portfolio and that retirement on track. One of the biggest problems I think investors face today is obviously time. You, the investor, have to make sure that the advice you get is helping your retirement and your portfolio go in the right direction. Remember, being too cautious and too conservative with your portfolio can really hurt you. Being sold a crummy annuity is going to hurt you. Non-traded real estate investment trust, garbage. Broker sold investments, garbage. Watch out for back-end surrender penalties and lockups on investments that somebody's trying to sell you. Never buy an insurance policy for your IRA or retirement. Garbage. These are all things that non-fee-only fiduciary firms push on you, the investor. Unfortunately, they make them sound good, and maybe your fear and greed kick in and you get sucked into one of these bad products. Remember, once you get into a lot of these bad products, it is almost impossible to get your money out without a huge back-end surrender penalty, sometimes approaching 14, 16, 18% of your money. Folks, I'm just about out of time. If you're looking for real advice, real money management, stop settling for bad advice. Call Rezny Wealth Management today. We are here to help you. We are a fee-only fiduciary money management firm. I have over 30 years experience managing money right down in here in Florida. We have offices in Naples, Fort Myers. We'd love to help you. We do manage larger portfolios, $500,000 and greater. If you're concerned about the advice you're getting and you want real advice, call our office, schedule a consultation, and feel good about the decisions you're making in the future. We will help you alleviate the pain and the frustration you're currently receiving. Make sure you have yourself a safe and profitable day.